Good morning, good afternoon, and welcome to Fidelity 2022 Conversations, Thinking Thematic. I'm Gabriel Wilson-Otto, Director of Sustainable Investing at Fidelity International, and I'll be your host for the next hour. On the agenda today, we have Fidelity's Global Head of Investment Research, Ned Salter, who'll be making the case for why we should look at investing in megatrends and our unique approach to thematic investing. After that, I'll be speaking with our investment team who'll explore opportunities arising from these themes, including the global digital transformation, Asia's growing innovation, and climate change. As a quick housekeeping reminder, if you do have any questions during the course of today's event, please send them to us via the Q&A box at the bottom of your screen, and we'll try our best to answer them at the end of the session. And if we don't have time, we'll get back to you via our client relations team. To get things started, let's run a short poll to get a sense of what's on your mind. You have 30 seconds to vote. And could we please bring up the first poll questions? So what we'd love to get your opinion on here is the perception of thematic investing. So how do you think about thematic investing? Is it a way to enhance long-term investment returns? Does it allow me to contribute to trends or issues that I or my clients care about? Or is it not relevant to my investment portfolio? So starting to see some of the answers come through, which is fantastic. Encouraging to see that there's a small portion of people that think it's not relevant. So hopefully we'll be able to change some of the minds of those participants as we move through the session today. We'll just give it a couple more seconds for everyone to give you a chance to answer. It still looks like it's coming through thick and fast. Great. Could we please bring up the results? It looks like we've got a significant number of answers coming in. And the clear leader is as a way to enhance long-term investment returns, and then followed up by allowing me to contribute to trends that clients or I care about. And for me, the enhancements of long-term investment returns is really one of the things that we're going to dig into now, and to better understand what some of these trends are and how they're related to our performance. We do have a second poll question, which we could please bring up on the screen now. And what this is looking at is, what do you see as the top themes to focus on in 2022? So are they climate change and decarbonisation? Is it technology and digitization? ESG, clearly a topic that's close to my heart. Healthcare innovation, or the Chinese consumer? And again, still quite a number of answers coming in, so I think we'll give it a few more seconds for people to digest the trends of relevance. Disappointing, ESG appears to be falling in the standings here. Okay, if we could please show the answers and close the poll. And it does look like technology and digitization, as well as climate change and decarbonisation, are the two leaders here. And so we will dig into both of these topics during this session, so you're in the right place. So thank you very much for your participation in that poll. Now let me introduce to you our keynote speaker, independent technology analyst and leading thinker, Benedict Evans, formerly a partner at Silicon venture capital firm Andreessen Horowitz. Benedict is widely sought after for his views on the tech sector. So over to you, Ben.
Hello, thanks for that introduction, and thank you everybody for joining the event. I'm going to talk very fast at a very high level, talking about some of the fundamental trends in the technology industry and kind of useful ways to think about them. And I think the framing that I will start with is a framing that thinks in terms of timing. So there are the things that the technology industry is obsessed by for what it might be able to do in 2025 or 2030. Meanwhile, there are the companies within the tech industry deploying ideas from 2015 or 2010, deploying all the ideas we had 5 and 10 years ago. And meanwhile, there is the rest of the economy, the old economy, so to speak, being disrupted by things that technology was excited by in 2005 or 2000 or 1995. So there are the ideas from the past that are still being deployed. There are technology ideas that are reaching fulfillment. And then there are visions for the future. So if I talk about each of these in turn, first, as we think about the future, I think you could say that people in technology there's really kind of two categories. On the one side, there is Web3 and Metaverse. On the other side, everything else, from satellites to quantum to autonomous cars to biology or indeed ESG. And if one just looks at these terms Web3 and Metaverse, these are both effectively attempts to rebrand, conceptualize, re-energize ideas that have been around for a while, and to say what they would really mean. Web3 is a way of saying cryptocurrency isn't just about digital gold and payments and money transfer. It's a new platform, a new computing system, a new way to build applications. Metaverse isn't just about VR headsets and games. It might be the next platform after smartphones. So if I talk about each of those in turn, first looking at Web3, there's an old quote from Voltaire who said that the Holy Roman Empire is neither holy nor Roman nor an empire. In the same way, cryptocurrency isn't really about cryptography. It's not secret. It's not really a currency, or doesn't have to be a currency. It's also not a database. If one says DLT or blockchain, again, these are not helpful ways to understand what this is. Instead, it's much more useful to think of this as a computing platform. The term Web3, hence, is an attempt to try and capture that. The original web in the 1990s was about individual publishers producing content, and the phrase Web 2.0 from the mid-2000s expressed the idea that all the users would be creating the content. That's what Facebook or YouTube or Yelp or Delicious, all of those kinds of products looked like. But in those products, the company still actually ran the network and captured the value. The users created the content. The idea of Web3, therefore, is that if these systems, these services and applications are created on a distributed computing platform, created on a blockchain, then the users wouldn't just be creating the content, they'd also be controlling it and taking a share of the value. This also incidentally means that one could think of this as being another wave of open source. In the original open source, all of the code was created in a distributed open way, but it then ran inside big companies. With Web3, the code is not just created in an open distributed way, but it runs in an open distributed way as well. Everyone can see the code as it's running, see what it's doing, see the business logic, see the transactions and the contracts and the payments. This is a very religious, a very messianic vision for technology. We go from closed, centralized products where companies make money and have lots of problems to a new, very religious vision of open, decentralized products where the users are in control, the users make money, and all the old problems go away and are just replaced by the old problems again in exciting new ways. This has obviously produced a great deal of excitement and a great deal of course, financial speculation. This is kind of the obligatory chart showing you market caps of cryptocurrencies. And if one digs into those valuations, that early digital gold store of value use case has a certain amount of interest in the financial services industry, particularly as compared to some of the other instruments that people can use to store value. But what's much more interesting are applications, software, or ways of using a blockchain to create software. And so here we have some interesting early traction. There are 5, 10, 20 million people using different kinds of applications that can be described as software as opposed to a simple money transfer application. And if one looks at kind of the hot topic of the moment, NFTs, there's a bunch of interesting charts. So in January, it looks like there was maybe $5 billion of transaction just on OpenSea, which is the main NFT trading platform. And there's a bunch of interest from people in the intellectual property world. This is Alexandre Arnault, son of Bernard Arnault, creator of LVMH, with his crypto avatar, his Web3 avatar, posting about Twitter's NFT experiment. On the other hand, if one looks at the user numbers, there's still only about 500,000 trading accounts. So there's maybe 10 or 20,000 people who are actually seriously involved in this. So this is still very, very small, very, very early. And I think that kind of expresses a general point that when one looks at Web3 or crypto or DLT or blockchain or whatever one wants to call this, it's still very early. It's still very technical. There's still a huge amount of stuff that needs to be built. It's still very fragmented and complex, but there's enormous creative energy. And that's really what people are excited about. If one goes back, I mentioned open source earlier. If one thinks about what open source did, people thought it was going to destroy Microsoft. And that didn't happen, but the iPhone is full of open source software. And yet it's not open source itself. And so these are kind of, as we look at what this might mean, we wonder, well, where will this end up? What will the scope for this look like? If one shifts gear and talks about metaverse, on the other hand, this is a much clearer vision, but also a vision that's much further out. It's a vision that AR and VR become the next universal device, and that everybody uses these things. And if everyone used them, what would that mean? And much as in the early 90s when people said, well, what would it mean if everybody had a computer and threw a bunch of buzzwords on a board and called that the information superhighway, now people say, well, what if everybody had VR and AR? What would that mean? And throw a bunch of ideas on a whiteboard and call that metaverse. Some of those things may happen, some of them may not. Some of those companies, some of them may not. But it's kind of difficult to tell at this stage. Meanwhile, if one looks at the real traction for VR, again, this is very, very early. It looks like Facebook had a really big Christmas, huge spike in interest, interesting spike in sales, but still remains relatively small. People are much less interested in VR than they are in Roblox, and there's still probably only 10 million VR headsets out there. And so if one thinks about where this might go, there's a sort of a very deterministic model that says, here we have this amazingly cool technology. The technology will get much better. And so it will go from a black and white phone to a smartphone. On the other hand, if one looks at something like games consoles also became much better, but only 200 million people have one, so they didn't become a universal device. And I think if one thinks more generally about what might happen by 2030, there is this framing, here are these technologies that are amazing and they must be part of the future. The question is, we don't know how big a part of the future, what kind of a part of the future that might look like. And that can also take a very long time. If one looks at the growth of mobile internet, for example, we were excited about that in 2000. Didn't really happen outside Japan and South Korea until 2010, arguably even 2015. And so we're going to have to wait quite a long time to work out what this would really look like. If one shifts gear now and thinks about the present, what's being built today, come back to my framing as Web3, Metaverse and everything else, but meanwhile we get on with deploying all of the great ideas from the 2000s and the 2010s. And in particular, there's this phrase digital transformation. And this sounds like a parody of marketing nonsense, something you might see on a billboard for an airport, a billboard for a software company at an airport. What it actually means is that in the 70s and 80s, big companies bought mainframes. In the 80s and 90s, they went to client server, to PCs, to Oracle and Microsoft and SAP. Now they move to cloud and to software as a service and to machine learning. And so we're going through this generational change in what computing looks like. This is still very early. Use of the cloud is still only sort of 10 or 15% of enterprise IT spending. So it's a long way. It's still only just starting. And the old paradigm can last for a long time. IBM's install base of mainframes is actually still growing. IBM shipped record mainframe capacity in 2020. So the old obsolete paradigm can last for a long time. But I think what's more interesting as one looks at this shift to the cloud is that changes what software is. You know, when you use mainframes, IBM gave you software as part of the package. When you went to client server, suddenly you could install software from actual software companies and you might have dozens of different applications. But as we go to software as a service, we might have hundreds and hundreds and hundreds of different pieces of software. This is data from Okta on how much software is deployed inside big companies. SaaS has meant they've gone from having 5 or 10 applications to having 50 or 100 or 150 different applications. And those applications can all do different things. They enable workflows, they enable the deployment of machine learning, they enable all kinds of new automation that wasn't possible in the past. So there's a great illustration of that from Vodafone. Vodafone has 2.5 million invoices a year and 40,000 queries. And those are all digital, they're all sitting in an Oracle database, but they're not automated, they're not in the cloud, they haven't had machine learning, they haven't had automation. And so for Vodafone, that digital transformation process means thinking, well, what would machine learning, AI and automation mean to process that volume of queries, that process of processing all of those questions. And so what we're going through at the moment is a sort of mass deployment of all of the ideas of software from the last 20 years, enabled by machine learning, enabled by cloud, enabling by all of these kind of building blocks, and so creating just sort of orders of magnitude more software companies and orders of magnitude more software inside of big companies. And of course, all of that has been accelerated by the pandemic. Meanwhile, of course, there's the rest of the economy and all the ways that the technology is changing that. And this is, I think, the best way to understand that is that everything that the internet did to music or newspapers is now happening to everything else. This chart expresses kind of the nature of that change. So you hear the impact of the internet on newspapers and then books and then pay TV, and you see it takes time. The atoms stop mattering, but when the atoms stop mattering happens at different times. It can also happen at different speeds. This is the shift of US retail to e-commerce, and so this has taken a lot longer. What happens as you go through these transitions, and this is a point you could have made in sort of 1995, is that all the old value chains and gatekeeping based on physical assets break apart, and you have all sorts of new channels, new entrants, new gatekeepers, and new winners. This is happening right now in TV. This is the collapse of the US pay TV market. It reminds me of the line from Hemingway, how did you go bankrupt gradually and then suddenly? Back in 2010, the CEO of Time Warner was asked if he worried about Netflix, and he said that was like worrying about the Albanian army. Obviously, in hindsight, that was not a great prediction. Today, Netflix and Amazon both spend more commissioning content than Warner itself. Netflix spends more than anybody except Disney. And both Netflix and Amazon, incidentally, spend more than all broadcasters in the top 5 European markets combined. TV production, script production of scripted TV shows has tripled in the last decade, and a third of that now comes from streaming providers. And if one looks outside of the USA, there are a lot of second-order consequences. So in the UK, 16 to 34s watch more subscription streaming, so more Netflix and Amazon than all content from broadcasters combined. So it's a kind of a fundamental reconfiguration of the industry. And of course, this is something that people first started talking about in 2005 or even 2000. It just took 15 years for it to happen. Much the same thing is happening in retail, which the conversion to e-commerce was a much slower process. It grew much more slowly. Nobody got excited about it in any given year. But here we are 25 years in, and it's now, by the end of 2019, it was 15 to 20% of retail revenue in the US and the UK. In the pandemic and the lockdown, we had a surge, obviously a much bigger surge in countries that had a big lockdown, such as the UK, and a relatively small surge in the US, which didn't really have a lockdown. And of course, it's also important to remember that this is unevenly distributed. So over 80% of people people in the UK buy online every 3 months, but only a third of people in Italy. Smaller percentage in places like Turkey or Portugal or even Greece and Spain. So you have this widespread of distribution. But what's also, I think, interesting is if you dig inside e-commerce and you split out grocery from things that can come through the mail. So if you only look at the portion of retail that can come through the mail, the UK is now at 40% online, which has all sorts of cascading consequences for real estate, for retail, for commercial property, and of course for how brands go about building their businesses. The other side of that is that Amazon has built its own logistics business, and in the USA, it was bigger than FedEx in 2020. Amazon has now said they'll be bigger than FedEx and UPS combined in the USA in 2022. Shift to the logistics model changes what that market looks like. And meanwhile, Amazon is also now bigger than Walmart. If one takes the value of everything sold on Amazon's platform, they overtook Walmart in the course of 2022. Now, as you create new channels, you also kind of create all kinds of interesting externalities. Amazon has built an advertising business in the last 5 years. In Q4 last year, they finally disclosed exactly what the number is. Amazon did about $31 billion of advertising revenue in 2021. To place that in context, that means Amazon's ad business is bigger than the global newspaper industry, also bigger than YouTube, bigger than radio, roughly the same size as Google's display business. So we have these waves of change and reconfiguration going on. Another example of change is Shopify, which did $175 billion of e-commerce in 2021, up from nothing 4 years earlier, which means that Shopify is about 45% of the size of Amazon Marketplace. So we have this completely new kind of competitor breaking into Amazon's market. We also, in advertising, have a new competitor that isn't a competitor. So Apple has made itself a fundamental power player in the online ad business, despite not really having an online advertising business, because it uses its controller platform to reshape how advertising can work. And the thing that sits underneath that, of course, is that as you change a channel, people don't just buy the same things but on a website. People buy different things. As you go online, then the brands that get bought, the products get bought actually shift, and the nature of the business shifts. I think a dramatic illustration of that, incidentally, is if we look at online sales in CPG, over a quarter of L'Oreal sales are now online. And so that fundamentally changes what kinds of things people buy, how they buy them. The best example of this that's front of mind today, I think, is Tian. Tian is now overtaken both Zara and H&M in global Google web search. In the US, Tian is now American teenagers' favorite online shopping brand after Amazon. And on credit card data, it looks like it's now the largest fast fashion brand in the USA, bigger than Zara and H&M combined. It's done that with a very different experience, a very different logistics and sourcing model, but without any physical stores. And so it's used a different way of thinking about go-to-market to build a completely new brand. And I think if I kind of generalize that point, any brand, any marketer, any retailer, any advertiser, anyone in this space is really trying to solve two questions. There's a logistics question, how do I get it? And then there's a discovery question, how do I know what I want? And you have these pools of hundreds of billions of dollars of spending. And in the past, those advertising, marketing, retail rents, and so on, in the past, those are all separate. You couldn't say, should we open stores in that part of the country or in that country, or just increase our ad budget or have free shipping. Now those budgets all become part of the same thing. So the addressable market merges into $1 trillion or $1.5 trillion segment. Now, if I kind of take a step back and think about what's going on here, there's a whole bunch of questions that I didn't talk about, many questions I didn't talk about, but one I just want to zoom in on. This is the first industry that was hit by tech, which is the music industry. And the growth of streaming means that the music industry has actually been, recorded music has actually become a growth industry again, although it's still only about a third of the peak from 2000. Now let's compare music to some other things. Netflix is 50% bigger than the entire global recorded music business. But then Apple's platform rents from App Store payments and search payments are bigger than Netflix. So just Apple charging rent for its platform is bigger than Netflix or bigger than global recorded music. Amazon's ad business, incidentally, is also roughly the same size as Netflix and bigger than the global recorded music business. And kind of what's happening here is that the technology industry changes all the parameters. It overturns the industry. It builds new roads and new railways and new dams and new passes and new mountain ranges. But it doesn't actually care about the effects of those. It moves on to other things. Technology isn't spending all of its time thinking about how technology has changed the ad business or the e-commerce business. Silicon Valley spends all its time thinking about quantum and Web3 and metaverse. It thinks about how the future is going to change, what it's going to change in building things. And there's two ways that you can look at this. One of them is to say that we've sort of spent the last 50 years, 60 years of the tech industry saying, what is a computer? What is a computer company? What's a software company? Who's going to have one of these things? And we've gone through these generational changes from mainframes, which were big companies, to PCs, which are all companies, the web, which was the global middle class, and now smartphones, which are basically everybody on Earth. Something like 5 billion people on Earth have a smartphone today, and there's only about 5.5 billion adults. So now the answer is everyone. And the next 50 years is, well, what is it that happens when everybody has a smartphone? And the answer is this becomes a systemically important part of society. I think a really interesting... Now, one response to that is we have a surge of investment in technology. Investment in private technology companies in the USA in 2021 frankly looks both terrifying and unsurprising if one thinks about the sort of 50% pullback in stock market valuations since then. But it also kind of reflects the size and scale of that opportunity. But what's also happening, I think, is that if we go back and look at this chart, the consequences of everybody having a computer are often felt outside of the computing industry. If one thinks of the last time this happened, this is an image with the cover of the Sears Roebuck Annual Report from 1960. And the story here is the first 50 years of the car industry was what's a car? And the second 50 years of the car industry is, well, what happens when everybody has a car? And the answer is Walmart, freeways, McDonald's, suburbia, the transformation of countries based on mass car ownership. Sears Roebuck thought this was fantastic. They've got this wonderful vision of a world of freeways and parking lots, and they thought this was great. But Sears Roebuck doesn't exist anymore, because actually the value of that opportunity wasn't captured by car companies. It also wasn't captured by the existing retailers. It was the creation of a whole new kind of company that capitalized on the fact that everyone had a car. Now we have, I think, a creation of a whole wave of new companies that capitalize on the fact that everybody has a smartphone, for better and for worse. And so with that, I will say thank you and hand back to the next speaker.
Cheers. Thanks a lot, Benedict, for those brilliant insights. I'd now like to introduce our next speaker, Ned Salter, Global Head of Investment Research at Fidelity International, who will share with us Fidelity's approach to thematic investing and the megatrends that matter. Over to you, please, Ned.
Thanks, Gabe, for the introduction. And hopefully we can continue on from the interesting insights we just learned from Benedict. Looking at the first slide, I wanted to talk today about investing in megatrends that matter. So if we could go to slide 2, I thought I'd sort of give a broad definition in the purpose of thematic investing. And the way we at Fidelity define that is that thematic investing is really focused on enhancing long-term returns. We define a theme as a structural trend that drives the growth in fundamentals for the associated companies at a faster rate than the market. That doesn't mean that every stock is a growth stock or every theme is a growth strategy. We're talking about the growth in fundamentals of the underlying companies that populate that theme. So not growth as a risk factor or a style factor, but really the growth in the fundamentals of the business. Thematic investing also matters a lot to investors' evolving needs and their evolving expectations. In years gone by, investors were exclusively focused on excess financial return or absolute financial return, and we call that single materiality. But today, clients are looking to add additional purposes into their portfolios, whether that's to reduce their carbon footprint or to help advance a particular social cause. In addition to the performance, the financial performance, clients and investors now expect to see an impact that their investments are making on society. We call that double materiality. So thematics don't invest necessarily across the whole market. We can identify the most exciting long-term trends, the industries that will benefit from them, and the individual securities that are best positioned to win. So really, it's a cherry-picking approach that allows us to most closely match an investment process with clients' swiftly evolving financial and sustainability-oriented goals. On slide 3, we've just talked about how thematic investing drives long-term returns. So how does it do this in reality? Ultimately, we think thematic investing cuts through the noise. And every time I look at this chart that you can see on your screen, I think about the famous Ben Graham quote. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. And there's certainly a lot of near-term volatility in the market, from rising inflation to rate hikes to COVID recovery to geopolitics to companies beating or missing quarterly earnings expectations. And these short-term narratives do drive multiples or discount rates to expand and contract. So we decomposed equity returns over the very long term, and we found that in the short term, 80% of the explanatory variable of the change in share price was due to a change in the multiple. So short-term risk appetite. Over the long term, however, that's inverted. 77% of stock returns over the long term are explained by the change in fundamentals, how well a company is performing in its earnings growth, in its cash flow generation over time. So what does that mean? It means that by focusing over the long term, these big structural trends and the companies with the best fundamentals associated with that trend and investing in those, we can cut through the noise and we can capture enhanced financial returns. On slide 4, we've talked about double materiality and how it means that investors can achieve a second outcome in addition to excess financial return. And in thematics, sustainability should more often than not be that second outcome, as thematic strategies offer investors an enhanced focus on sustainability, as well as the ability to target specific social or environmental challenges. And on slide 4, which is on your screen, we'll talk about the 4 reasons why there's such terrific alignment between thematic investing and sustainability. The first is investment horizon. The long-term focus of thematics, which is really thinking in decades, not in quarters, lends itself well to sustainability, and hence there's a significant overlap. As investors, we have to have as much confidence in firms' future cash flows, as well as in policies and engagement with stakeholders and shareholders. The second is integration, and this is critical. At Fidelity, we believe that sustainability analysis cannot be disaggregated from fundamental financial analysis, as sustainability issues have a direct influence on fundamentals. And this is why our sustainability analysis is conducted by the very same investment professionals who focus on the financial analysis. They must be linked together. And of course, sustainability factors vary by industry and geography, and therefore they're best understood and applied in the local context, local business models, and therefore our on-the-ground presence enable us to capture those really important nuances. Source of value is critical. This analysis adds value to our investment process by highlighting companies that have strong sustainability characteristics and therefore an impact on cash flow through cycle. These factors are not always appropriately priced by markets and are more often short-term focused. Finally, on engagement. Because we're thinking in decades, not in quarters, it matters to us that the companies that we invest in on behalf of our clients, these business models and their operations are sustainable and have the ability to endure. We take an active ownership approach and strongly and firmly believe that this kind of engagement with company leadership is the most effective way to positively influence corporate behavior. We're all on a journey, and working together certainly makes a difference. This approach is not only evidenced through our voting, but also in our willingness to divest in companies where our engagements have not been successful. So turning to slide 5, I wanted to illustrate the power of investing through a tangible example, and this is related to the theme of demographic change. Demographics describe historical and projected changes in populations which have the power to bring about significant economic or social changes that could affect income and expenditures at all levels, thinking through their impacts on countries, on companies, and individuals. Demographic changes are obviously slow moving, and they play out over long periods of time. And sometimes that means that their cumulative impact is not properly discounted by sometimes myopic markets. And so what's interesting about demography is it's one of the social sciences where projections can be made with relatively high levels of certainty. So looking years into the future, we're able to predict key features of populations and how they might change. So we thought we'd share some interesting facts that our analysts and portfolio managers are thinking about every single day. And this is a look forward to 2050. So in the first instance, in 2050, we will be older. In fact, 1 in 6 people will be over the age of 65 by 2050, with seniors representing the fastest growing age group. And this will have critical ramifications on the economy. First, it will obviously put pressure on the labor supply, which will boost demand for industrial automation or robot solutions. With longer lifespans, there is a longer period where the functionality of the human body will decline, and that will clearly create a wide range of demand for healthcare products and healthcare services. And as populations age and the number of seniors increase, this older cohort becomes a consumer group representing a multi-trillion-dollar market. And this group obviously tends to have very high spending potential given their high incomes, but obviously has higher health and personal care needs. So the composition of spending may change over time. And this creates opportunities for many sectors, including wealth management, beauty, discretionary consumer, and of course, healthcare. In 2050, there also will be more of us. The population will be 10 billion people, and you'll have relentless trends of industrialization and urbanization. So we'll see surging energy demand, plus 80%, food demand up 70%, and water demand up 55%. And achievement of this is simply not possible under our existing way of operating. So we're going to have to find more innovative and sustainable solutions to solve these challenges, and creating a backdrop for companies that's very positive for companies who are at the forefront of innovation in this space. And finally, in 2050, the emerging markets middle class will be bigger and wealthier. And the swelling of that middle class is set to accelerate at a very swift pace. The middle class spending will increase by 64 trillion by 2050. And the growth in the emerging middle class, it does provide support for a wide range of products, in discretionary products from phones to fashion and electronics and automobiles, boosted, of course, by the trends of premiumization, which is where consumers trade up for superior products as their income rises. So these trends, aging population growth and emerging middle class, form three of the core pillars of our global demographic strategy. The kind of analysis you've just seen form the underpinnings of all of our thematic strategies. So on slide 6, how do we build these thematic strategies? Our theme ideation process, that's what we call the process of coming up with our new ideas. Ideation process is built on real life insights that we can draw on, in particular from Fidelity's proprietary research team of about 185 analysts, our macro team conversations with CIOs and even outside industry experts. And unlike a top-down approach where we think of just kind of buzzwords such as digitization or wellness, which many asset managers like to use because they're quite catchy, we really use a scientific, bottom-up expertise and understanding to come up with the next themes that we think are most important to our clients. We use a robust scientific thematic assessment process, and we think about 9 separate criteria when determining if a theme is viable or not for our investors. We think about upside potential, sustainability characteristics, or the size of the investable universe. Once we identify a potentially attractive theme, we leverage proprietary natural language processing, or NLP technology, and of course, revenue and profit-based assessments to construct initial universes. And then our investment professionals scrub those universes and determine whether or not we should pursue a theme. And if we should, what's the best way to pursue a theme? But core to the process is what we call thematic purity. And this is the most important takeaway. We will only invest in a theme if we think we can deliver a strategy with high levels of thematic purity. And across the asset management industry today, there are many examples of theme washing, investing in strategies that claim to invest in certain themes, but when you unpack that portfolio, you see allocations to securities that aren't driven by growth in that theme. So we use proprietary tools to assess thematic purity at the portfolio level, at the sub-theme level, and of course, at the individual security level, so that we can be confident what we're delivering is what it says on the tin. On slide 7, I think we can look into our process in real time and review some of the strategies that we're building today. Now, whilst these strategies aren't available yet as pooled funds, it gives you an insight into the ideas and investments that some of our clients are looking at and that we'll be delivering in the coming years. The first is China Next Gen Healthcare, which captures the twin trends of an aging population and an evolving healthcare system. Over 40% of China's population will be over 60 by 2040, and over 60s spend more than double on healthcare than adults in their 40s and 50s. The China pharma industry is dominated by low-value generics, and Chinese government has made it a priority under its Health China 2030 to drastically improve the quality and availability of healthcare services in this decade. Biodiversity strategy recognizes that over a quarter of the world's species are currently threatened with extinction, and as natural ecosystems are declining everywhere. We've seen the number of mentions of biodiversity in company earnings calls and filings increase by more than 100% in the last 5 years. And over half of investors now believe that biodiversity will become one of the most important investable topics by the end of the decade. So that said, there's a real lack of investment solutions here with a high degree of thematic purity. So we're focused on developing one for the benefit of our investors. The circular economy strategy recognizes that only 8.6% of the global economy today is circular. UN SDG 12, if you're familiar with the SDG goals, calls for the sustainable management and efficient use of natural resources, as well as to substantially reduce waste generation through prevention, reduction, recycling, and reuse. A circular economy has huge potential benefits to the world, from lowering CO2 emissions to increasing disposable income to cost savings. The nutrition strategy is based on the notion that our current food system is failing us. About 2 billion people are suffering from food insecurity around the world today. But despite failing to feed everyone, the sector is still responsible for 25% or so of the world's greenhouse gas emissions and using half of the world's inhabitable land. With a growing population, this is unsustainable. But we see real opportunity to invest in companies that are driving changes to fix this, from plant-based dairy to 3D printed meat to precision agriculture and vertical farming. And finally, our clean energy strategy. The energy sector is the source of a huge amount of greenhouse gas emissions in the world today. And to hit our 2050 climate targets, global clean energy investment needs need to quadruple from the current levels, and we must see a 4x ramp in the pace of solar and wind installation. Finally, on slide 8, we've discussed some key ideas in the pipeline. But let's have a quick look at existing and ready to invest products. As you can see, it's a differentiated offering spanning more focused approaches from a sectorial perspective, such as technology, financials, and healthcare, but also from a country perspective, i.e. China innovation and China consumer. You can see the strong alignment of our solutions with sustainability, as we've discussed, like Sustainable Future Connectivity, with its differentiated focus on digital ethics, climate solutions, and water and waste, tackling some of the most pressing environmental issues of our time, and sustainable consumer brands, investing in businesses, putting sustainability at the core of their identity to benefit from consumption trends while mitigating and solving for some of their externalities. Global demographics is another solution whose 3 key sub-themes we unpacked earlier on slide 5. So beyond being based in powerful, long-term, proven structural trends, our existing strategies do share that bottom-up fundamental approach, which has enabled them to deliver attractive long-term returns for clients, as well as delivering double materiality. So with that, Gabe, I'll happily hand back to you.
Fantastic. Thanks a lot, Ned. And from my side, it was really interesting to hear Ned show us how we can successfully harness the megatrends shaping our world to make rewarding long-term investments. And prior to that, a great presentation from Benedict on how technology is disrupting and reshaping competition and the next big things to look out for in tech. And now moving on, I have with me 3 colleagues from our investment team to build on these insights and discuss opportunities in the themes that we've identified. I'm delighted to be joined by Velislava Dimitrova, Portfolio Manager of Fidelity's Sustainable Climate Solutions Fund and the Fidelity Sustainable Water and Waste Fund, as well as Tian, Portfolio Manager of Fidelity's China Innovation Fund, and John Guinness, Portfolio Manager of Fidelity's Sustainable Future Connectivity Fund. So following on from Benedict's perspectives on the state of play in the technology space, I think it'd be great, John, if we could start with you. The markets have been turbulent, to say the least, and within these pockets of the technology sector globally have been under significant pressure. In your view, do you think valuations are attractive? Is now a good time to invest? And where do you think some of the best opportunities in the tech sector are?
Yeah, so thank you very much indeed to everyone for coming and listening to this event. So that's a great question. So firstly, I think that it's important to separate the short-term noise and volatility from the kind of long-term structural trends, as Ned was talking about. We're very excited about the kind of connectivity theme for a number of reasons. Firstly, we think we're very early in the 5G investment opportunity. Telecoms companies are only now investing heavily in 5G. In the US, it was only at the end of last year that the US telecoms operators spent almost $100 billion on 5G ready spectrum. And so it's only now that they're rolling out the telecom equipment and networks to support that. And so we're starting to see some quite good results coming out of companies like Nokia and Ericsson. In addition, telecoms companies, enterprises, and cloud companies are also investing in their core networks because they're shifting everything to the cloud, and you need very good connectivity if all your data's somewhere else off premise. And so we're also seeing some great investment opportunities in companies like Arista, Ciena, Juniper, and Cisco, which have been quite boring companies historically, where the results have really started to do well because companies are investing hard in their core networks. Furthermore, we believe that the investment in 5G networks and core networks will spread around the globe. For example, here in Europe, we've hardly started investing in 5G networks. There's a very low level of investment, but that's accelerating now. And then enormous countries like India, they haven't even started their 5G spectrum auctions yet. We're very excited. Reliance Jio, one of the companies in India, transformed India with their 4G investment. We can't wait to see what they do with 5G. But secondly, 5G and the speeds that 5G brings, we believe will lead to huge innovation. So for example, home broadband fired by 5G connectivity. So in the US, the mobile operators have started selling very, very fast 5G home broadband solutions. T-Mobile US think they'll get to 8 million subscribers, but that's just in the US. Imagine how powerful that solution will be in emerging markets where there's less investment in fiber and copper, where they can leapfrog and go straight to very, very fast fiber-like speeds. And so again, we can't wait to see what happens in countries when 5G is rolled out and everybody gets access to 200, 300, 400 megabit per second speed. Secondly, private networks. We're seeing companies like VW in Germany create their own private, totally secure 5G networks. Imagine a car factory, say in Wolfsburg in Germany, where they're connecting all of their robotic arms and all the pieces of equipment, all the cars, even the employees with 5G modems. So they can instantly know where everybody and everything is at any one point. So it's very exciting times. Thirdly, IoT everywhere. We believe that the very low cost of 5G and the instant setup will mean that everything becomes connected. It's such a hassle when you try and connect your TV to your home Wi-Fi, etc., or your home speakers. It's just annoying. But with 5G connectivity, it will be instantly on, straight out of the box. What does it mean? You know, cars will have 2 5G connections, one for infotainment and one for self-driving. Everything from traffic lights to office heating and cooling, even our own children will be connected with 5G. So we'll know where everything is instantly, and there'll be tons of information going up and down. And then finally, augmented reality and virtual reality. So Benedict talked about this a little bit. But it's very interesting that companies like Facebook, they're spending $10 billion per year investing in AR, VR. Apple are probably spending a similar amount, if not more. Microsoft have got the HoloLens. Google have got their investments. Sony have got their investments. Everybody's investing in AR, VR. So it's undeniable that some very big, very clever, very technologically forward people are investing large amounts of money in this. So we're very excited to see what they come out with. And again, it will be a killer application for 5G and for augmented reality. So that will be very exciting. So sort of just to conclude quickly, we're very excited about the connectivity opportunities. We believe the opportunity is ahead of us, and we believe the 5G cycle is only just starting. It's a long-term, huge trend, and we believe it will happen regardless of what happens to inflation, what happens to COVID, or whether Russia invades Ukraine. This is going to happen regardless of all of that. It's sort of an independent theme. And finally, within the connectivity theme, there are loads of sort of mini themes, from 5G rollout to 5G home broadband, Internet of Things, the connected car, AR, VR, all investable right now, and all of which we're very, very excited about. So I hope that gives you a flavor of some of the stuff we're thinking about at the moment. Thank you.
That's fantastic, John. And honestly, I can't wait for it. It sounds like my life's going to get a lot better in the near future with all of those developments coming on board. So great to hear about all of that. If we're looking at the ability for technology to solve problems, this immediately brings to mind for me one of the key issues we face globally, which is climate change. So if I can use that to move on to Velislava, how do you think about addressing the climate crisis? Do we have the technology solutions in place to actually deal with this challenge, and also what opportunities sit within that space, and how do you identify really good investment opportunities within that space?
Thanks, Gabe. Thanks everyone for listening, joining us today. That's a great question. As you know, we're relying very heavily on carbon fuel to power our economy today, and this is not ideal. But fortunately, over several decades, humanity has come up with a range of technologies with the potential to significantly reduce our dependence on very carbon-heavy technologies. And these new solutions are many, too many to list all here, but just to mention a few, from ones that have been around for a while, like building insulation, renewables, or recycling, to the very nascent ones like alternative protein and fuel cells and autonomous vehicles, just to name a few. If all of these are adopted fully globally today, we can reduce our global emissions footprint by more than 80%. This transition needs to happen extremely quickly, though. We need to fully adopt all these solutions in less than 30 years. Yet it has taken us more than 150 years to get here. And these 30 years compare with much longer historical rate of adoption. If we look at electric power, for example, it took us 47 years. Cars took 90 years. This rapid transition will transform the global economy, every aspect of our lives, and it will represent the largest investment opportunity in our lifetime. And this is because we need to invest $4.8 trillion every year. This is a cumulative of $144 trillion out to 2050, if we are to reach zero carbon world. This transformation cannot be achieved without purely through government subsidies and incentives. We need investors to be fully behind it to help increase the scale and reduce cost of these low carbon technologies. By investing in them, we have the unique opportunity to both be part of the solution to a very urgent problem we're facing, but also benefit from that transition. For wider adoption, these technologies' costs have to decline further, and therefore to generate alpha, we need to focus on those parts of the value chain where barriers to entry are higher and competitive dynamics are more favorable, protecting pricing and returns for investors. I have to say here that there's a wide range of approaches to investing in climate. Some measure the carbon footprint of a portfolio relative to a benchmark. Minimizing this is a very feel-good factor, but it does little to fight climate change, as it can be achieved by allocating capital to inherently low carbon emission sectors like media and financials, to pick a couple. Another approach is investing in the beneficiaries of climate change, like healthcare, infrastructure, and clean water. But again, these cannot help us decarbonize. The highest possible impact way of supporting the solution to climate change is investing in the low carbon technologies, helping reduce their cost for everyone and helping both public and private companies to achieve their Paris-aligned targets.
Fantastic. And for me, what that really just highlights is the rapid transition that's required in order to achieve this. And the numbers that around the investment on the back of that is just a huge opportunity. If we look at it at a firm level, I'd just like to quickly highlight that as at Fidelity, we've also set a firm-wide target to be net zero in our own operations by 2030 and from all of our investments by 2050. And this is in addition to some interim targets in order to halve the carbon emissions of our investment portfolios by 2030. So really taking on board that urgency and making the firm level commitment in addition to the portfolio level opportunities that come up in the thematic opportunity set. If we're thinking about the environmental impact of companies, we've spoken about the climate change side of things, but Velislava, just staying with you, just extending on environmental impacts, what are some of the other investment opportunities created by other environmental megatrends outside of climate change?
Yes, well, climate change is probably, it's a very urgent problem to solve. There are other environmental related opportunities as well. And another megatrend we have identified is water and waste. Water and waste are actually two sides of the very same problem. One is powering the economic development, and the other one is a byproduct of it. Both are growing themes with very, very long duration predictable drivers, and these are growth and sustainability. In terms of growth, population is still growing, people are still moving to large cities, and the middle class is still growing. And this is because economic development is very resource intensive. One pair of jeans takes 8,000 liters of water to make. And everything that we consume today becomes waste within, on average, a couple of years. Another driver is aging infrastructure. Infrastructure in the developed world wasn't built to handle the current volumes, and there is a very urgent need of upgrading it. Leakage rates of some water pipes in the US, for example, can range of 20 to 40%. These are really unacceptable levels. And finally, sustainability. Climate change is leading to increasing risk of flooding and drought. And this requires significant investment in infrastructure to be able to handle these and to provide stability of water supply, of clean water supply. In terms of waste, we're seeing at the very beginning of what we believe will be a huge shift away from unsustainable practices like burying waste in the ground, which eventually leads to leaching of chemicals into water and soil, and burning waste, which releases carbon dioxide. A shift to a more sustainable practices like the new recycling technologies, solutions to help us reduce the volume of waste we're generating, and solutions extending the useful life of the products we're consuming. In terms of stocks opportunities, there are many, from water and waste utilities, industrial companies building the infrastructure for water and waste, consumer companies like, for example, secondhand clothing, or technology companies like automation software.
Super interesting. So it sounds like if we think about the solutions to address both climate change and increased resource efficiency and reduce waste, we do have technologies in place. What we need is investment and scale, and also enhancement of cost of operation and efficiency. And so if I think about technology and scale, Asia is always front of mind within that frame. And so maybe with that, Tina, I could pass to you to get your view on how innovation is developing or flourishing in this part of the world, and some of the investment opportunities that innovation and technology is creating.
Thanks, Gab, for the question, and thanks everyone for your interest. Indeed, in Asia, we have seen a lot of innovations, and in particular, China is an emerging innovation superpower with a lot of deep-seated structural advantages. If you think about China's advantages, it starts with an unparalleled talent pool. The country has the most science and technology graduates, and China's R&D spending has increased by 4 times in the past 25 years. And the result is clear to see. China now has the largest number of patents being granted globally. Another key advantage is in data. So China has the most internet and smartphone users. Among them, 900 million Chinese use mobile payments regularly. All these browsing and spending generate massive amount of granular data about individual consumer behavior that can be used to enhance user experience and creates a virtuous cycle. And indeed, in the past 2 years, the pandemic has really accelerated the adoption of some of the innovations, such as e-commerce, food delivery, digitization, and automation. In terms of opportunities, we see 3 key areas. The first one is technology innovation, including artificial intelligence, digitalization, automation, robotics, and smart driving. So AI in particular is a great opportunity, which needs a lot of data input. And as just mentioned, China is really well positioned with the structural advantage in data. The second area of opportunities we see is lifestyle innovation. These are based around transforming and improving people's lives through innovative solutions. Healthcare innovation offers huge opportunities here. China is the second largest healthcare market globally and will outgrow many other markets driven by the rapidly aging population. And as Ned just mentioned, the whole healthcare industry in China is transforming from previously generic drugs focus to innovative drugs driven by R&D. And there are also emerging innovative healthcare service models such as telemedicine. And the third area is environmental innovation. So these are focused on products and processes that contribute to sustainable environmental protection. And renewable energy is a particularly compelling long-term opportunity we see. So China actually dominates major part of the global renewable energy supply chain, and its own ambitious carbon neutral plans require huge investments in renewables too. Over to you.
Thanks, Tina. And if we stay with China, in 2021, we saw significant volatility in the tech sector on the back of regulatory enforcement actions. I'm really interested in your view as to how you think about regulatory risk when investing in China. Clearly, there's some amazing investment opportunities and fantastic growth, but how do you navigate those structural opportunities with some of the risks that might exist from a regulatory side?
Yeah, thank you for the question. Indeed, we've seen a lot of regulatory changes in the past 1 year. If we take a step back and look at all these regulatory actions, I think they're focused on three key areas: antitrust, data security, and income equality. So those regulations are really meant to promote fair competition, protect the vulnerable groups, as well as to ensure proper use of data, as the Chinese government is now more aware about the need for digital ethics. So we actually believe all these initiatives will drive a sustainable growth for China. And in terms of digital ethics, Fidelity is a firm advocate for that. We have been engaging with companies who handle a large amount of data, encouraging them to adopt a proactive approach to digital ethics. And other than regulations, another risk on people's mind is China's macro slowdown. So the regulatory pressure on the property sector will inevitably lead to slower economic growth, and the restructuring of the industry will continue. Also, late last year, we've seen some power shortage issues, which had some impact too, but has been easing, as we can see now. In addition, the zero COVID policy in China has really affected the service industry in a major way. But as COVID situation normalizes, we expect some tweaks in the policy at the margin. So going forward, the government is taking more supportive measures. The Central Economic Working Conference sent a clear signal of promoting growth. We have seen rate cuts, local government debt issuance ceiling being lifted, and accelerating lending. Despite all these risks, we still see opportunities in China market from growth and valuation perspective, but we need to pick those with lower regulatory risks. So areas to avoid include after-school tutoring, property, and low-quality healthcare. Within tech, we believe the localization remains a structural trend, despite some near-term cyclical volatilities. Semi-fabrication and chip design are two areas that China is quickly catching up. And even within internet, there are opportunities because despite the higher compliance costs brought by regulations, the impact on many companies' business model has been limited, while regulations actually open up opportunities for smaller innovators. Outside tech, we believe areas of innovation such as renewable energy and industrial automation are benefiting from strong and sustained regulatory tailwinds. At the end of the day, we believe that innovation remains a key priority for China and a critical driver for sustainable, high-quality growth of the country.
Fantastic. Thanks a lot, Tina, and thanks everyone on the panel for a thought-provoking discussion. Indeed, geopolitical tensions and inflation are dominating international headlines and short-term movements in markets. And globally, the transition to a higher level interest rate environment creates the potential for policy missteps and further volatility. But against this volatile backdrop, we strongly believe that investors need to look beyond these short-term fluctuations and identify opportunities to invest in megatrends that will shape the investment landscape for years to come. So, unfortunately, that's all we've got time for today, but thank you so much for joining us. I hope this has given you some food for thought and insights into the investment opportunities presented by thematic megatrends. I'm also conscious that we didn't get a chance to answer the questions we received during the session, but don't worry, we'll get back to you directly. And with that, thank you very much for your time. And here's a quick treat from all of us at Fidelity. We hope you have a great rest of the day. Thank you.